All right. So in chapter 3 is hedging strategies. So again, you can go long the futures. And it's extremely valuable when you go long the futures, especially when you're exposed to input costs that are rising. So oil, gas, heating oil, interest rates. So you want to lock in that price. So if prices go up, especially input costs such as gas and oil, as the input prices go up, then your margins are going to be reduced. So you're trying to hedge off any upward movements in prices. Or you may want to, I mean, if you're a speculator, you take advantage of it, but these are hedging strategies. And then the short futures, let's say you have a currency portfolio or a bond portfolio or a stock portfolio, and you're anticipating the value to drop, either because of rising interest rates or recession. You want to hedge off the loss in the value of your portfolio. So you would short or write the futures contracts or the forwards, but we're talking about futures. Basis risk, in every contract, in every index, there's basis risk, where the futures price is not perfectly correlated to the underlying spot price. So there's some lack of correlation. Even if there's a little correlation, say even 30%, you could still use the futures contracts to hedge off your risk. You don't have to have perfect correlation. So the basis risk is the lack of correlation between the spot and the futures price or the index. So there's going to be basis risk between the index and the futures contract and the futures contract and the option contract. So the long hedge, F1, is the futures price today when you enter the contract. F2 is the futures price next period when you anticipate purchasing the asset. S2 is the asset price in which you're going to purchase the asset at in the next period. B2 is the basis time in which you're going to purchase it. And F1 minus F2 is the gain on the futures contracts. So here, you got the asset in which you're going to purchase it next period. You got the futures price minus the futures price in the next period minus the futures price today. So that difference minus the asset price is going to give you the futures price today plus the basis risk. Okay. And then this is the long position, this is the short position. And the only thing that changes is the sign. When you're trying to calculate the hedge, how many contracts do I need to buy to be able to hedge my position? So you have there's a couple hedging methods for hedging calculations, but they're basically the same. So you have the standard deviation of the spot price divided by the standard deviation of the futures price times the correlation coefficient, which is basically, this is the change in the price, and this is the change in the price. So it's the volatility of the spot price divided by the volatility of the futures price times the correlation coefficient between the spot price and the futures price. So here's an example of the correlation coefficient, standard deviations, and then the hedge ratios. I couldn't kind of figure this out. So this was the price of a gallon of gas times 2 million gallons, gives you your total exposure. It's a purchase of gas that you're anticipating. If you take the total amount in which you're purchasing to try to protect against rising prices, you can take the price per gallon to get the number of gallons that you need to hedge. The number of gallons divided by the number of gallons in each contract. Times the correlation, or times the hedge ratio. So it's the total gallons you're trying to hedge divided by the number of gallons per contract times the hedge ratio. It's going to give you the number of contracts you need to buy to be able to hedge that total exposure. Basically, this is pretty much the same contract, but this is for an indexed futures contract. So you have the volatility for the index, volatility for the futures price, times the daily correlation between the spot and the futures price. It's going to give you the optimal number of, or the hedge ratio that you're going to need to apply to the number of contracts to hedge off the position. So another way to do it would be to look at the quantity, gallons, or the value that you're trying to hedge divided by the hedge ratio, or times the hedge ratio. So the next is bond yields and bond forward curves and zero curves. And we know that the bond yield is basically just the IRR. So you can solve the bond yield if you know the N, the I, principal amount, coupon, and you can solve for the yield to maturity of the bond. And then this one is the par yield, which is really the coupon yield at par. So if the bond is issued at 10%, interest rates are 10%, the par yield is 10%. Forward rates in future zero rates are implied by the term structure. So we've already talked a lot about term structures. And is the T-year rate. So R is the T-year rate. So this is 2 year, 1 year, and then between the two periods, we'll give you the forward rate. So the forward rate, let's say this is a 2 year, this is a 1 year, 2 minus 1 will give you the forward rate. So you can forecast interest rates by calculating forward rates, forward interest rates. The yield curve. When the yield curve is upward sloping, the forward rate is going to be greater than the zero rate and going to be greater than the par yield. When the yield curve is flat, the forward rate equals the zero rate equals the par rate. And when the yield curve is inverted, it's the par yield that's greater than the zero rate and greater than the forward rate. There are what are called forward rate agreements, which are over the counter, that basically states you're going to get a certain principal in a certain future time period. It's valued assuming that the forward rate is achieved. So you could have predetermined or LIBOR. So the RK, predetermined forward rate, T2 minus T1. And then LIBOR, you have the forward rate minus the predetermined rate, T2 minus 1. So a forward rate agreement could be the principal minus the forward, the K rate minus the forward rate times the time period and the interest rate to get a forward rate. Duration on bonds, basically the present value of the cash flows divided by the bond price for over some time period. So obviously as the bond price goes up, the duration goes down. As the interest rates go up, the duration goes up. When you look at duration and convexity, oops. Oh, did I not skip? I think I skipped. I went straight to 4. Hold on. Sorry, that was probably confusing, wasn't it? I apologize for that. I had it all numbered too. So let's go back. I apologize for that. So hedge ratios, continued hedge ratios. So again here, it's the beta. You're doing index futures, the beta, the value divided by the value of the futures contract to get the hedge ratio. So if you have a $5 million portfolio, and the contracts are in $1,000, you divide those to get the number of contracts times the beta to give you the number of contracts that you'll need. If you need a 2-year hedge, you're going to have to roll the futures contracts prior to the ending period, so right before year 2, you want to close out the position and take another position. So you have to replace it with a new contract, and there could be some liquidity issues with that. In chapter 4, you look at interest rates, and there are different interest rates that you're going to use in the derivative contracts. You could use the Treasury yield curve. You could use the LIBOR rate out of London. And again, this is a interbank borrowing rate, secured, unsecured, sorry, it's unsecured. And there's been some LIBOR fixing scandals by the major banks, which I think was we all know was a pretty big deal to have collusion and LIBOR fixing. And it's based off of a survey. The federal funds is an interbank overnight rate, and then the repo rate is a short-term repurchase agreement where you're going to sell the bond at X and you're going to buy it back later at Y, and the spread between in which you sold it and which you buy it back, that's the repo rate. That's the implied interest rate. When you're looking at these bonds, there's different types of compoundings: annual, semi-annual, quarterly, monthly, weekly, daily, and continuous compounding. And if you're going to do continuous time compounding, you're going to have the number of periods, and you're going to log the return over the periods divided by the number of periods to adjust, for the compounding periods. And then here is how you would adjust it for the continuous compounding. And in most cases, you're going to use continuous in a lot of the calculations. So if you're doing 10% semi-annually, it's 2 logged 1.05. If it's 8% continuous on a quarterly, there's the 8%, there's the quarterly adjustment minus 1. The bond price is the discounted cash flow of the coupons under a 0 rate pricing. So you can see here the rates, and then the compounding periods taken to the E to be able to get the bond price. We've seen this before. The bond yield, the par yield, or IRRs, forward rates, future 0 rate implied by the term structure. We already went through a lot of this stuff. To talk a little bit about the duration, so that when interest rates go up, bond prices go up, duration goes down. When bond prices go down, duration goes up. And the way you want to look at convexity in the bonds, you want to look at them like this. So this would be a bond with 0 convexity. So it's going to be the change in the price, right, and its effect on the interest rate. So the way to look at it is elasticity. It's really elasticity in the change in the bond price to the change in the bond interest rate. So different bonds have different sensitivities to changes in interest rates. This would assume that it's linear. This would be convexity. So bonds have different maturity. And duration. and credit quality will have different convexities. So obviously, the longer the maturity, for the duration of the bond, it's going to be more convex, more sensitive to movements in interest rates. Lower quality bonds are going to be more sensitive to movements in interest rates or in credit spreads. So it's really, convexity is really the price elasticity of the bonds based on movements in interest rates or movements in credit spreads. So you can trade convexity. In bond traders, look for bonds with different sensitivities based on movements in interest rates and movements in credit spreads. Okay, any questions? Okay, I think I'm going to end it there. Yes?
Can you explain how to trade on convexity?